So a major Wall Street firm just told its investors they can't have their money back. It's not fraud or nothing, but, I mean, you could say that. But this is the private credit industry. $2 trillion in it. So, big thing right now in the news, kind of, again, what I said in the last video on the back burners compared to Iran. But it's BlueOwl Capital. You probably never heard of it. I haven't for a while, until recently. But BlueOwl runs a fund called OBDC2. It's got $1.6 billion in that, where regular retail investors, you and I, not accredited, can put money into. And they pitched 11% yields. Sounds great. But the problem started when people got nervous and they wanted their money back. It's kind of like, you ever watch It's a Wonderful Life, the bank scene where George Bailey's kind of like scrambling to give people money. They're like, oh, I need it back. And then, he has nothing in the bank. He uses his own $20. But redemption requests hit over 15%. And, of course, they can't honor all of that. It's like anything, any bank or nothing. Of course, private credit's much more over-leveraged compared to a bank. But February, they shut the gates. No more withdrawals. They got to wait or sell at a big discount. And, let's see who would buy it. But their stock dropped 10% when they announced that. But this kind of spread throughout the whole private credit industry. Blackstone, Apollo, all of them dropped off 5%, 6%. And this is kind of the cockroach thing. If BlueOwl has a problem, what about the rest of them? But I'm going to explain what is private credit. When a normal company needs to borrow money, usually goes to a bank or issues bonds. But in private credit, it's specialized funds. Like BlueOwl, they lend money directly to companies, bypassing banks. BlueOwl is not a bank. I own any private credit industry, they're not banks. That's the first flag. Not much, you can't really see what's going on because they're not a bank. But the appeal is there's basically a 0% interest rate. Well, there was. So, and then these funds were offering yields of, over 10% by taking on more risk and having over-leveraged funds. But the loans inside these funds are locked up for years, and investors were promised they could get their money back every quarter. Doesn't happen. Did not happen. So right now it's at $2 trillion in size, like I said earlier, doubling in the past 5 years. And what's been happening, it's kind of gone more public in a way. It's gone away from the big investors, like hedge funds and whatnot, towards people like us. Because who doesn't want 12% return on their money? Duke University said that ownership of these funds, institutional ownership of these funds, have dropped about 25%. So, these are just regular people. It's just like buying the S&P with the rest of your paycheck. These guys are the ones lending to fintech, whatever, financial technology, during kind of an emotional period in finance and AI. So, a lot of emotions. So, BlueOwl was the first crack in this kind of thing. How many more are hiding? Who knows? But I'm not saying private credit is inherently bad. There's a good purpose for it. But what's dangerous is the shift from institutional and accredited investors, like big companies, fintech companies, to regular everyday retail investors, into things that are not very liquid. Nothing that is for retail should be illiquid or even semi-liquid. Everything that retail can have access to, besides maybe real estate, but equities, bonds, whatever, anything that retail investors have access to need to be highly liquid. You can trade NVIDIA anytime you want, all the NASDAQ stocks, whatever. You can pretty much get a fill in 10 minutes. And people a lot of times forget that, high yield means high risk. People don't realize that. And then doesn't help that the fact that these funds are not very liquid compared to VOO or QQQ, whatever. So, if you have any questions, leave it in the comments. But I'm just trying to explain the private credit industry and why it is in the news.